So welcome to this week's Trend Signal Trading Podcast. It's a podcast that gives a lively run through the markets, what to look out for, and how to improve your trading as well. My name is Adrian Boothie. I'm the head of trading here at Trend Signal. Now, usually I'm joined with Jerry Miller, but he's having a bit of well-deserved R&R. He's over in Australia at the moment, so you're stuck with just me, I'm afraid to say. But don't fear, because there's lots of content for us to get into. We're going to be talking about the market moving on to new highs, sort of swatting off the coronavirus. We're going to talk a little bit about Trump's impeachment. We're going to talk about China pumping 173 billion into the economy. We're going to be looking at the markets. What are the key support and resistance levels to look out for this week? What are the key economic announcements to look out for this week? What's going to be driving that movement there? And we're also in our defining trading section. We're going to take a look at support and resistance. I know it sounds a bit dull, but you know what? It's a fantastic way of helping to identify key levels from which the markets can have significant movement, and movement means opportunity. So let's get into it, shall we? And we'll start off with what do we know? So here we give a bit of a run through of what's happened over the last week or so, and I guess to some extent how we could have known about it before the event. But basically, global markets last week recovered from really their previous week's losses. You might remember last week's podcast, we talked about the coronavirus, we talked about the US equity market taking a bit of a bath. Actually, we've recovered dramatically, they, over the other side of the pond, and the Dow hit new all-time highs, and the S&Ps hit new all-time highs as well, probably a little bit stronger on the S&Ps there. So, big recoveries, actually. Although analysts are still sort of talking about a significant impact on global growth, China being an element of concern. And we're going to talk about, the movements there, and we're going to talk about how the commodities have moved and so on a little bit later on. Interestingly, a lot of the fall in the equity markets was based on the coronavirus, and there's been lots of comparisons with SARS virus back from 2003, because it's the most sort of recent big sort of virus. There are similarities there and so on. Just to give you an idea, to date, the total number of infected is over 40,000, with a total number of fatalities now at over 900. I was actually reading about it in this morning. I think it was a record high number of fatalities at about 92 or something yesterday. But interestingly, in terms of new cases, it is starting to stabilize a little bit, and that's all of adding to the dismissing of it, if nothing else, from the US equity market. So despite the mortality rate, approximately 2%, it's about a fifth of the SARS virus, but the number of fatalities has exceeded that of SARS due to the significantly higher number of infections. So there's just more of it, basically, compared to SARS. And you know what? That had a big impact on the markets last week and the week before. Week before, big falls. This week, back up again. FTSE up 2.5% on the week. The Dow up 3% on the week. The S&P 500, the broad S&P 500 index, up 3.17% on the week. The DAX up 4.1% on the week, and the Nikkei up 2.68%. So very strong on those global equity markets. And whilst the coronavirus threat clearly remains, the US data on manufacturing really did help push US indices higher as well. The ISM manufacturing PMI data posted a reading of 50.9, which is well above the consensus 48.5 and above the all-important 50 level that indicates growth again in the sector. So that's really important. The week finished with a surprisingly strong non-farm payroll number. Let's have a quick look at that. Where are we here? So last week, non-farm employment change, non-farm payroll, it certainly has a few names really, but we're expecting a consensus of 163,000 jobs being created. It came in at 225,000, very much stronger than expected. And you would think, all other things being equal, good for the dollar. As far as equities are concerned, let's have a quick look at the charts and see where we were. Big movement down really on Friday there from the Dow, from the S&Ps, really making a rise in interest rates more likely, which might slow things down a little bit there. So anyway, We also found at the same time, the other reason for pullback on Friday could certainly be as well a bit of profit taking into the weekend. A lot of stuff can potentially come out over the weekend, and people get a bit nervous about that. If you think about 1, 2, 3, 4 big days in a row there off those lows from the big sell-off on Monday, anyone who bought down here, they might be thinking, do you know what, that's a gift. I might take that into the weekend. So a little bit of profit taking there potentially, really too. As for other news, the People's Bank of China pumped $173 billion into the Chinese economy to bolster growth in the wake of the spreading coronavirus epidemic. And despite the central bank action and more encouraging global data, global markets remain very nervous as the coronavirus infection rate accelerates. And many Chinese businesses are still closed following the extended bank holiday following the Chinese New Year. However, the Chinese administration are keen for businesses to reopen soonest as the likely hit to growth increases. What's interesting there is that there is an argument that the spread of the coronavirus has been somewhat subdued by the holiday season in China as everyone goes back to work. A lot more traveling again, potentially there, a lot more commuting, and people out of their homes. Will we start to see the infection rate go up a little bit? Time will tell. Other big news last week: Trump was acquitted in his impeachment trial. Maybe that was seen as a positive to the markets, although you'd have to argue, and we've talked about this in recent sessions, that actually it was highly unlikely that he was actually going to be prosecuted anyway, because it needed a bit of a swing. It's a largely Republican Senate. I say largely, they have a majority. They needed, I think, 7 Republicans to vote against Trump. As it turns out, it was only one, Mitt Romney. Anyway, that's that. It's done, and we move on. I guess currency-wise, euro dollar down 151 pips, 1.36%. Sterling dollar down 320 pips, that's 2.42%, and dollar yen up 135, and that's up 1.25%. So a strong week for the dollar. Positive US data really did help it to one of its best weeks in the last few months. There, sterling weakened more than most as Johnson's aggressive approach to upcoming trade negotiations increases the risk of troubles ahead. It was always going to be difficult, let's face it, but out of that volatility does create certain amounts of opportunity there. Commodity-wise has been interesting as well. Last week we saw the likes of crude oil take a bit of a hit. UK crude, that's Brent crude, that's over from the Middle East, was down 3.5%. US oil down 1%, so much stronger there. So Brent crude down $2, US oil only down 50 cents. So quite a significant difference there actually. Gold down $20, that's only about 1.25%. And you could say, given the movement in the equity markets, that's quite a modest pullback actually. And I probably think that copper moved up actually. We're up 1.3%. Over the period of time. While we're talking about copper, bit of a bellwether for the Chinese economy, has a huge influence on the Australian economy as well. Oil markets are very much stuck in a downward spiral as gloom as price slumps of more than 20% from the peak in early January, indicating a technical bear market, which is something we discussed in previous podcasts. OPEC are considering dramatic supply cuts to bolster prices as the cartel seeks to protect members' interests. The main beneficiary likely to be the US, which now leads as the world's biggest producer. The turnaround in markets last week inevitably hit safe haven assets such as gold, which fell in knee-jerk style to the recovery in global stock markets. We can have a quick look at gold here. Certainly not had the moves to the same extent as the indices there, but certainly a big pullback towards the beginning of the week there. What was that, Tuesday, when the equity markets really started to move there. But interestingly, they've both been rising whilst the markets have been rising. So not perfectly correlated there. Copper recovered slightly. Let's have a quick look at copper as well. I need to just add it in, I would think. Bear with me a second. So you can see copper there recovering a touch there by Sniper with the trend from a couple of days ago. If you're looking at it on the chart there, but otherwise a massive sell-off, really not had the recovery that one might have expected perhaps, but certainly positive at this stage, not really denting the significant losses though of previous 2 or 3 weeks. Okay, so we've done the run through of last week. What about for the week ahead? What don't we know yet? I guess really being the question. Let's have a quick look through the main events for the week ahead. Let's just go back to our economic calendar and let's just have a look at what we need to be looking out for there. So a few bits kicking around really. That's last week. Let's look at this week. Sorry, Monday, absolutely nothing. When I say nothing, when we look at the filter, look at the high impact items, those red items there on the Forex Factory site there. So really sort of nothing doing there. Japan, bank holiday tomorrow there. But in the UK, fourth quarter GDP, we're expecting a 0% there, a flat number. GDP data is always backward looking, and this data release is particularly less relevant as it largely covers the troubled period in the run up to the general election. So sort of an element of discounting it to a certain extent. And that sort of feels a little bit like that when we had our interest rate decision last week. Was it the week before? It sort of gets all lost in the mists of time, really, that sort of let's just wait and see how it goes, really. In the US, we've got the Federal Reserve, Jay Powell, chairman, starting his 2-day semi-annual testimony before Congress on monetary policy. Dollar and equities are sensitive to any surprises, re-rate moves. Not really likely to get that, but any rate move per se. But people will be listening to the tone, the language that's going to be said over the next couple of days. Bank of England's Carney is testifying to the House of Lords Economic Affairs Committee, and again, this is likely to be sterling sensitive as well. So maybe some movement going on there. Moving through to Wednesday, probably one of the biggest items for the week is the Royal Bank of New Zealand's a monthly policy meeting where they're looking to make a decision on what they do with interest rates. Obviously, interest rates have been one of the major items they have in their arsenal, in their armory, whatever the expressions are, to control money, to control inflation. So they are typically big numbers. This one will be coming out at 1 o'clock in the morning. That's Wednesday morning. That's Tuesday night. Obviously, so keep an eye out for that. Not expecting any change there. So looking to stay at 1%. But there's a statement as well. So always be aware about what's happening in the statement. Are they putting more guidance out for more cuts, rises, whatever? That's what people are really listening to, is what's said and what that's likely to mean. Are you going to be trading at 1 o'clock in the morning anyway? Probably not, but it'd be interesting for the following day, that's for sure. Certainly be a little bit aware about New Zealand dollar trades that you might have open into Tuesday night's close. Obviously later on the day we've got Jay Powell's second day of his testimony. Thursday, core CPI, that's an inflationary number, consumer price index there. That's important because that's the main measure that central banks use in order to use monetary policy, such as interest rate change. In the US, it's a little bit different because they look at inflation, plus they also look at unemployment. In the UK and most other central banks, they're looking just at inflation, but in the US it's inflation and employment. That's why non-farm payroll is seen as such an important number in the US. Risk remains skewed to the downside in the wake of the coronavirus and the slump in commodity prices as well. They're expecting a forecast of 0.2% inflation there over the period. And then finally on Friday, retail sales, expecting a bit of a pullback from January's stronger number, looking at 0.3% for core and for sort of standard retail sales as well. These are both sort of important numbers, CPI and retail sales. So if you're day trading those short-term charts, just be aware of those data points there. You don't really want to be in positions over those data points, so you want to be in before them. usually a little bit flatter coming into it, not a huge amount going on there. We wait for the number, and that's when a lot of rejigging of the portfolios tend to come in. So from the hedge funds, pension funds, and so on, as required. So what you do normally get there is movement, which can create opportunity for short-term day traders as well. So it's about what happens just after 1:30 that really is a little bit more interesting. In other news, what to look out for next week. We're still, buried knee deep into fourth quarter earnings in the US. There's 70 of the S&P 500 reporting this week. Notable ones including Kraft Heinz, PepsiCo, Cisco, and AIG. So we'll keep our pencils sharpened for those. If you've run a US stock portfolio, be aware of what's going out there. It does tend to lead to some movement in the markets as a bit of a shock. Announcements can tend to come out, so be aware of that. Maybe risk manage accordingly. But that's it really for the week. Not a huge amount there, but there are a few bits to keep get our teeth into, very much so. So in this week's What Should We Be Trading, we're going to take a look at the markets that have been moving around for us over the last few days. Let's look at a few potential opportunities and let's see really what's going on, I suppose. So let's just bring my charts in and we'll start off with a look at those US indices. Buy the Dips was the name of the podcast today, and you can see why. A ridiculous move back with the US 30. You can see on the chart here if you're looking at it on the video side of it. But obviously, we've gone from a move down from a lows of 28,200, let's say, up to 29,500 in just 3 or 4 days. That is a significant rally there, and it just goes to show and just goes to reiterate that point of where else are people supposed to be putting their money. There is no alternative. Tina, people have been talking about for a long time, and it just happened to be the case again. As soon as there was a merest hint that the coronavirus was under control and Trump was going to be acquitted, and China putting a bit of capital in to boost the economy. Hey, it's okay, business back as usual. And you saw then massive move back into the market there. And we saw the same thing with the S&Ps for obvious reasons. Dow being 30 of the biggest stocks in the US, the S&Ps being the 500 biggest stocks in the US. They're going to move in a similar kind of way. Very, very strong. A bit of a pullback on Friday there, but by and large, a very, very strong move, and it does make it difficult to want to short this market. And this is the funny thing. We talk about bear markets, we talk about corrections and all that sort of stuff. When this market does have a big sell-off, and people are talking about it being next year or whatever, who knows when it's going to be. It's going to be quite hard to be on it for the massive move, because you'll identify the turns like this, and maybe you'll take a decent proportion out of that move. How easy is it going to be to ride it all the way down when it has that 20% correction? That's going to be pretty challenging because of the number of times where it's looked the same but hasn't had that degree of a fall. But all we can do is take it one trade at a time and play the probabilities. So when we have sell trades like this one we saw on the 23rd of January, it led to a 7 or 8% fall or whatever it was. I can't remember exactly what the percentages were, but it was a nice enough opportunity, and you play the probability. That's what's more likely to happen than expecting that big 20% fall, and just take what's available to you realistically. Anyway, dollar was a bit of a mover last week. Let's have a look at dollar Swiss. There's a few continuation trades, a few snipers as well. We've talked about dollar Swiss a little bit in recent weeks. And really the thing to note here on this chart is about looking at the trend. Big strong downtrend on this market there. You can see those arrows on the left-hand side of the chart pointing down, suggesting the path of least resistance is down until it starts to reverse back the other way. And that's something that we saw. I did a video on this last week talking about the buying opportunity from the 6th of February, and it's moving really nicely in our direction so far. Now, pip wise, you're not going to get fat trading dollar Swiss. Percentage wise, it's fine, but it's not like 500 pips or anything like that on a trade. It just doesn't move that fast. But then the stops are much tighter anyway. But the point being is that we had that move down. We hit that low on the 10th of January. That was a new low from a lower high, and so on. As we then rallied up against the longer term trend, we had a buy sniper against the trend. It's a slightly higher risk opportunity because it's against the longer term direction of the market. We talked about that in a lot of videos of late. And that led to a nice rise, but crucially, it led to a higher high. So the high from the 29th of January took out the high from the 10th of January. So higher high, then the market started to go back again, formed a base again around the 31st of Jan, 3rd of February, which was ended up being a higher low. So the low from the 31st of January was higher than the low from it wasn't the 10th of January, it was the 16th of January, my mistake. The point being, we're starting to see a new pattern. Higher low and a higher high, or rather a higher high, then a higher low. And then we started to break back up again, giving us that buy sniper. So in terms of context, the patterns are suggesting a reversal. We've since that buy then moved on to new recent highs for dollar Swiss, and the trade moving on in the right direction. That's a similar sort of thing that's going on a number of those other markets there. For example, dollar yen, a good move as well. There's been some great sniper trades in recent days, but again, you're seeing a similar sort of pattern. This was a buy continuation trade back from the 4th of January, just a few days ago, and it's moved on really nicely. And once more, you're not expecting massive moves. The ATR of dollar yen is only like 47 points. It's not a huge, fast-moving market. So you've got to take out of it what you can. Do you see? But look, what you've got there, again, you saw the movement high, the buy back from the 8th, 9th of January. That led to a new high, a higher high. Then it pulled back, giving us a sell sniper. That led to then down to the 31st of January, a higher low, and then that gave us a buy. So the patterns are again doing the same sort of thing. When we talk about chart patterns, sometimes it's horribly complicated and people get into all sorts of weird and wonderful detail. I don't. I like to just keep it nice and simple. Are we showing higher highs, higher lows? If we are, then it's really identifying a change in that direction, or the trend could be adjusting the other way. So like here, we're long anyway, right? As a buy continuation trade, it meets the 3 rules for a buy. But the context-wise as well, it's on the back of a nice strong chart pattern. Higher high, higher low, giving us a nice potential opportunity from there. And that's one that I took, and it did the ATR. Okay, maybe we'd expect a bit more than that, and it's just stabilizing at the moment, but it's done the ATR, which is really, the main thing that you'd expect out of a move like that. The ATR, the average true range, that's a typical movement on a daily's candle between the high and the low. That's not the exact definition, but it's close enough for today's purpose. Also looking at euro dollar, again, I did a video about this during the day of the 6th of February, which I put out on YouTube as identifying, calling the sell trade. There, you may well have seen it. You may not have done. Have a look on the YouTube channel if you haven't, and just search trend signal on YouTube, and you can see the similar sort of thing. You're looking at the downtrend there. Look at the arrow on the left-hand side of the chart. That's pointing down longer term. We are expecting these markets to move to new lows. So lower highs, lower lows, lower highs, lower lows, and so on. See, you've got a buying opportunity here, but the chart pattern was down. It was against that arrow, so it's against the longer term of the trend of the market. What this basically means is that you are expecting a sort of a smaller move. You're expecting a move like this, okay? And whilst you can get moves back up against that trend, hopefully if you've seen this on YouTube, or you've seen this on a blog site, or if you've seen this live, then what you're going to see is the movement back up, okay? That's likely to be small up because it's against the longer term trend of the market. I always like to talk in football terms. It's a bit like Liverpool losing one game and then they're more likely to then go on and win the next run of games. This is the sort of thing. That's the loss. It was against the normal direction. And then the market's going to go back to the way it was before and moving back down alongside those longer term trends on the left hand side there. Do you see? So it's about harmonizing with the market, and you see that really quite clearly on the charts. We had what we call a sell continuation trade on Thursday evening there, and already it's done the ATR objective. So it's a nice move for us, or maybe just shy of the ATR, but it's a nice move to begin with, and very much on the right side of us. So interesting trading opportunities on the dollar, dollar Swiss, dollar yen, euro dollar, pound dollar. There's lots of those movements around as well. Another one I wanted to look at was something we touched on earlier, which was copper. Big move down and potential opportunity to buy really from here. Now, this may not be for everybody. Copper isn't for everybody. That takes up quite a lot of margin, and it's also a bit complicated in terms of its trade size as well. And it's not the market we start our new traders off on. But interestingly, given the context, it's really as a play on how you feel about China. If you feel that that the coronavirus is contained, then look. If the market then fell dramatically because it was uncontained, if it then starts to be contained again, you'd expect a bit more of a rally, wouldn't you, really? And particularly since China's then pumping 137 billion or whatever it is into the economy to negate any negative effects here. So, really, there's a lot of potential for this market to move up if that coronavirus becomes contained. If it doesn't, if suddenly it outbreaks a little bit more, then you look to see this market move to new lows. But interestingly, it is giving us an opportunity there. There was a buy a couple of days ago. We're small down on it at the moment, but as I said, it's high risk. It's not something that our newer traders are on, and we'll see how it pans out over the coming days, won't we? But for now, really, the movement, you're looking in the dollar, you're looking in those US indices, and you're looking potentially keep your eye out on those commodities as well, particularly if they start to restrict supply. You might start to see oils start to give us some buying opportunities too. Always be a little bit careful with oil. Keep your trade size low because it is quite a volatile market, but keep your pencil sharpened there. But that's it, really. That's for our market review. So keep an eye out, please. So in this week's Defining Trading, we're going to have a look at, support and resistance. And before you start rolling your eyes and thinking, oh, God, we'll keep it kind of brief today. What I'd like to do is sort of go through things for just a couple of minutes, really, just to give you an idea about why it even exists, really, in the first place. And to do that, we're going to take a look at a chart. If you are just listening to this on SoundCloud or Spotify, it's fine. We'll try and make it as illustrative as possible just from what I'm saying. So I'm just going to bring in my charts here, and we've got a chart here for the pound against the US dollar. So what is support? What is resistance? It's really a function of the way in which the market moves at certain levels. And the idea is being that the markets or patterns repeat themselves. The market has a memory, market has a history. And when the market returns to certain prices where reactions have taken place before, then you perhaps expect that to happen again. So to give you an example, if you look back at a chart from pound against the US dollar back from the end of October and November and early part of December, it's quite a big resistance level. We use pivot points. We've got our own pivot points here at Trendsignal that identify those really clearly. Got a level around 129.50. A number of levels where the market kept hitting that level, stopping in its tracks, and then going back down again. Then it rallied again in the middle of November, hit it, stopped in its tracks, and then went back down again. It's a bit like the price resistance, a bit like the price hitting the ceiling, and then stopping, and then coming back down again to the floor. You see, the idea of it is that. And then sometimes it'll break through resistance, like it did in the beginning of December, powered through it, a bit like it's smashing through the ceiling as prices then move on to higher prices. Now, you'll get the similar sort of thing to the downside, hitting the floor, hitting the floor, hitting the floor, bouncing, hitting the floor, bouncing like a bouncing ball. But sometimes if you throw something through the floor hard enough, at the floor hard enough, it will go through the floor and it'll break lower. Again, we saw that just literally a couple of days ago with prices starting to break below that 129.50. So what was support, resistance, now becoming support. Don't worry about the technical side of it at this stage. Let's just get an idea about why it actually occurs. It's a bit of a self-fulfilling prophecy in a way. Let's think about it this way. When you're looking about foreign exchange, you're thinking about shares. It could be that there's just a big institutional order. Maybe a share price is going up to 500p and you've got a big institution, a pension fund, hedge fund, something like that, who says, right, I want to unload my shares in company X at 500 pence. So he's got an order with his broker who's going to do that. Maybe he's got a massive order working in the market, or maybe his broker's just going to start massaging the orders in whilst it gets to around that sort of price, trying to get around 500 pence. Whatever it is, the point really being is that you can get a build-up of selling pressure at certain levels. Why? Because maybe somebody wants to offload stock. Maybe somebody wants to buy a load of stock, and someone's thinking about maybe buying a company and says, right, just buy me whatever, buy me 50 million, buy me a couple of billion, whatever, I don't know, of a particular stock, but around this sort of price. So anytime the price goes down to that level, it starts hitting it, and it starts hitting those buy orders because somebody out there is trying to buy, or someone or something is trying to buy huge chunks of that stock. So it's stopping the price from going down. So that's on an institutional level. And then, of course, as a self-fulfilling prophecy, the more people start talking about support and resistance and so on, the more of a thing it actually then becomes, I guess, the more technical it becomes. So, what you have is people start looking at support, it's looking at resistance, setting their orders off it, and start selling just because we're hitting resistance, or buying just because we're hitting supports. And that all adds to the movement of the market around those sorts of levels. Why does price then burst through support and burst through resistance? Well, eventually you're going to get to a point where there is no selling pressure left. Maybe that guy who's trying to sell all that stock, like we're talking about here on sterling dollar, or he's trying to buy that company, he needs to buy loads of pounds. Maybe he's trying to buy a UK company, he needs to buy sterling instead of and selling dollars to do so. Gets to a point where he's just got to keep paying higher prices, unfortunately, because there isn't enough sellers there to buy at the price that he wants. So he's got to keep buying at higher prices. That's eventually going to push it above support. Why does it then often accelerate as it moves through? Well, let's think about stop losses, okay? Because if the market has a previous number of times it's hit this level, like this 129.50, then the obvious thing for people to do is put their stop loss above 129.50, above 130, something like that, like we're seeing from the end of October, early November. What then happens is everyone's short, people are short on that level, and as it takes out that high, as that price surges on higher through those short trades, they have what's called buy stops. You're going to buy your trade back to close it. So they're buy orders. So then as the price rises, all those sell orders are triggered, suddenly then actioning a load more buy trades, which then hits the market, pushes prices violently faster sometimes, and that's why you see a lot of movement suddenly very quickly as markets break key support and break key resistance. Why is this useful? It's useful to know because markets do have these memories. You can look at any chart, particularly using these trend signal charts when you've got these pivot points there. Markets will almost always have a big reaction off these numbers, find a level of support, find a level of resistance that you could then make your trading decisions based on. Do you see? So it's useful because it helps traders be timely in their decision making. It helps them identify good areas, good zones to buy, good zones to sell, whether that's entering trades, whether that's closing trades and taking profits. So it is an important way of trading, already adding to your decision making process. For me, I go through periods where I don't tend to use it too much. For example, when I'm just trading with the longer term trend, I don't worry about support and resistance too much there. I'm just focusing on the longer term trends. When I'm going against the longer term trend of the market, I will use things like support and resistance to help me time trading opportunities. So for an example, I think there was one, was it New Zealand yen a few weeks ago? So there was a sell trade here, pretty standard sell trade against the longer term trend of the market. But why was it interesting? Because it rejected that resistance level there. So it hit it, rejected it, and so on. So we can use support and resistance to give us context, maybe to give us buy sell trades in their own right, but also to give us context so that when we see our trade, we can see that it's a nice looking trade, and it has also rejected resistance, which is adding to its probability that it'll be a successful trade. It's becoming more confident in my eyes that this is a good trade to take, and therefore more likely to take it. Do you see? And it doesn't have to be a lot more complicated than that. But that's it really, and that's it for today's defining trading. Now, everybody, the action doesn't just stop there. If you want to tune into more live trading events, then we actually teach you a strategy. Then get yourself booked in for one of our events we've got this week. We do 3 events a week, typically, where we go through and teach one of our favorite trading strategies. It's called the Sniper Strategy. We call it the 3 simple steps, learning 3 simple rules to boost your trading. It's really about how we identify simply, confidently turning points in the market for FX, indices, and commodities. If you get yourself attending one of those sessions, you can also get an opportunity to be invited to our advanced trading seminars and webinars as well. So get yourself booked in, make sure you attend, and we'll teach you that strategy. You'll need to go to bit.ly/learnts. Let me give you that URL again, or that web link again, bit.ly/learnts. What you can also do as well is access the Trend Signal Trading podcast in a variety of different mediums, guys. It's not just during our live cast, but also you can watch it on our website, on our blog page. You can listen to it on Apple. You can listen to it on iTunes, that is. You can listen to it on SoundCloud, Spotify, and watch and listen on YouTube. Priority access is on our website, trend-signal.com/trendsignal-blog. So trend-signal.com/trendsignal-blog. And for more videos and stuff like that, go to our YouTube page. Just search for Trend Signal on the YouTube platform, and you see loads of educational trading videos that's going to help you become a better trader as well. So get yourself dialed in, subscribe, like, comment, whatever it is you want to do. Have a great week's trading, though. So for myself and the rest of the Trend Signal team, hopefully we'll see you at one of our events this week. But otherwise, have a great week's trading. Bye-bye for now.